Senior Manager of the Market Outreach Division at the Hong Kong Monetary Authority. On behalf of the Alliance for Green Commercial Banks, I'm very pleased to welcome you all to join today's training session, Green and Sustainable Market Evolution, co-hosted by the Alliance and Standard Chartered. In this session, we aim to provide a holistic understanding of the latest development in the sustainable finance market, which has seen remarkable growth. Sustainable financing is no longer a fringe activity in the international capital markets, but there is an increasing proportion of issuers financing in ESG-labeled format, and many sovereigns leading the way with the inaugural sustainable bond issuances. Today, industry experts from Standard Chartered will be sharing with us different types of ESG-labeled bonds and loans, the process of creating a sustainable finance framework, and subsequent reporting and monitoring. They will also share with us the process of obtaining an external review with specific case studies on first-of-a-kind transactions. Please join me to welcome our speakers from Standard Chartered, Ms. Tracy Wong-Harris, Head of Sustainable Finance Asia, and Ms. Ariel Lim, Sustainable Bonds Debt Capital Markets. Rahul is not feeling well today, and Ariel will be speaking on behalf of Rahul. Over to you, Tracy and Ariel. Thank you.
Thank you, Susanna. Thank you for the kind introductions. Delighted to be here today to kick off the first Alliance training sessions and to share with you, together with Ariel, to share with you the sustainable finance market update, introduce you to the ESG bond and loan and the insurance processes, and we'll be sharing some case study, and we'll be looking forward to have a active dialogue discussions with you during the Q&A sessions. With that, let me share the screen so that, one moment. Okay. So with that, let me kick off the market. So I think the graph tells the story. You can see the very strong growth over the last 10 years, and that's across globally and in Asia. In 2021, the market has exceeded $1.6 trillion in total market volume globally, and you can see the strong growth followed in also Asia as well. In 2021, the market doubled of the size globally and 3 times triple in Asia. So this is very encouraged to see. This is one of my favorite graph. I always call it from green to rainbow. From very early on that we've seen the green loans and green bonds started in the market to move to GSS, green social sustainability, which is sustainability is mix of the green and social, to sustainability linked loan, which we'll share a little bit more later with the massive strong growth over the last 3 years, and to the transition financing. Now, green bond is still the biggest part of the overall market, taking close to 40%, and sustainability linked loan follow as the second market, taking over a quarter. Now, during COVID, last 2-3 years, we have also seen a very strong pickup in the social bond area, taking a total market share of 13%. With that, let's take a look at the sustainability linked loan market. So as I mentioned, enormous growth over the last year. As you can see, 2021 is 3 times of the market from last year, from the previous year. And the SLL issuers are 70% are from corporate, and the remaining largely is from FI. And looking at the jurisdiction, you can see that Singapore, China, Hong Kong has the biggest market share, and the segments are very, very diverse across financial, energy, consumer stable, technology, industry and material. So across, very, very diverse. Just to highlight a couple of characteristics in the sustainability linked loan market. which Ariel will share a lot more in the subsequent slide. But just to call out the differences, the key differences between Asia and Europe. So we have seen in Europe, the sustainability-linked loan margins are tied to the performance of the borrower, so with incentive and also penalty. However, in Asia, we have seen majority of the market are one-sided with incentive only. In the recent last 12 months or so, we have seen the pickup on the mirror structure also started in the region. Now with that, let me pass on to Ariel to share with you the bond market.
Sure, thank you, Tracy. So for the green and sustainability bond market, this essentially started in about 2006 to 2007 with the first issuance of a climate awareness bond by the European Investment Bank. But more recently, the market has grown significantly since then, from being a one-off issuance to kind of a more mainstream format that most issuers are tapping the market in. So previously in the past few years, when we are making this chart, which is actually a heat map of which countries are most active, which countries and regions are most active in the issuance of green and sustainability bonds, we do see that Europe is a clear leader in this area. They are leading the charge in many areas, from the development of taxonomies to regulation in this region. However, we do see that in the past few years, Asia has also caught up significantly. Some of these are driven by top-down state-led efforts. For example, in China in 2015, they published the Green Bond Catalog to inform the financial institutions on what kind of projects can be considered as green, so that they could start issuing more green bonds. So from the next year onwards, China, next few years, in fact, China was the top issuer of green bonds globally. So if you can move on to the next page, as Tracy previously mentioned, why I was referring to green bonds initially is because green bonds was the predominant format that most issuers were tapping the market in. However, over time, as you can see on the two charts on the bottom, with the development of more principles that are laid out by the International Capital Markets Association, such as the social bond principles, sustainability bond guidelines, and sustainability linked bond principles, there are more and more formats that issuers can tap the market in, and we do see increasing diversification within the market. In terms of issuance trend, the ESG bond market has crossed a significant milestone last year in 2021, crossing $1 trillion US of issuances for the very first time. And this is in fact more than the past 3 years of issuances combined. So we do see that last year was in fact a tipping point for the sustainable bonds market. And this trend will be set to continue with more and more issuers continuing to issue sustainable bonds. Another point that I would like to raise also is that while the sustainable bonds market has grown significantly, the overall pie in terms of debt issuances by different issuers globally has not grown by as much. So what this tells us is in fact that more and more issuers are choosing to refinance their bonds and outstanding debt using new green or sustainability labeled formats or instruments. And we do see this as a trend that is set to continue. So I'll pass the time back to Tracy. Oh, so yeah, apologies. Let me continue on this slide. So to go into more detail on the different types of instruments you mentioned earlier. So previously, before 2018, the bond market was 90% in the format of green instruments, and that was similar for loans as well. So for green bonds, this is the most simple and standard form of a sustainable bond, where the proceeds are used to finance or refinance eligible green activities. And the ICMA and Loan Market Association does provide us a few guidelines in terms of what categories of activities do qualify as green, such as renewable energy, clean transportation, green buildings, etc. Slowly but surely, the market has developed further to develop new principles, including the social bond principles and social loan principles. So what this allows us is to use the bond and loan and other financial instruments to finance or refinance projects that are tied to positive social benefits or outcomes and serving specific targeted populations. So the key aspect for social bonds is the need to address specific target populations that will benefit from these projects. And moving on, we have the sustainability bonds. These are all considered as use of proceeds instruments. So for sustainability bonds, it is simply the combination of green and social projects within a single instrument. The last type of use of proceeds instrument that we have seen emerge in the market is the transition bond, which is less commonly seen in the loan market and predominantly only in the bond market. So what this transition bond is most of the time it has been used as a use of proceeds instrument where it is targeted towards issuers from specific hard to abate sectors. These are heavy carbon intensive sectors that are not really aligned with the Paris Agreement pathways, and they need intensive investments in order to transition their business models to be aligned with the Paris Agreement. So for this instrument, it is slightly more complex, and I will go more into detail later, but essentially it requires a shift in business model or shift in investments towards greenhouse gas reductions. The final type of instrument is the sustainability linked bond instrument. This is unlike the ones we have mentioned previously because it is not linked to specific underlying projects, be it green, social, or transition. However, the proceeds can be used for general corporate purposes. The main difference is that the bond characteristics like bond or loan characteristics like Tracy mentioned earlier, this will be tied to the performance of the issuer against some specific sustainability targets. And whether they achieve or do not achieve these targets, there will be a corresponding adjustment in the bond or loan characteristics. So I'll pass it back to Tracy.
Sure, thank you. So thanks, Ariel, to share with us the market sweeps of different market standards in widely being adopted. And as Standard Chartered, we have established adopting all these international market standards, and we have established 3 frameworks. First is the Green and Sustainable Product Framework, which covered the wide scope of our product, and I will share in the subsequent slide. And then the Sustainability Bond Framework that like Ariel mentions. And finally is the Transitions Finance Framework on the back of supporting the massive drive of for the just transitions. We have published the Transition Framework also to facilitate this effort. So with that, let me also share with you the whole suite of product, green and sustainable finance product available in the market that as Standard Chartered, what we offer. In addition to the loans and bond, which this session will cover in more depth, I want to share with you that outside of that, there are other products also available in the market. For example, sustainable deposit, which is available for corporate, for financial institution, and to the retail. Also on advisory, we have ESG advisory to help our clients to with their ESG journey in terms of ESG rating enhancements or ESG disclosure, sustainability target setting, etc. Also, derivative, we have seen a quick uptake on ESG-labelled derivative on interest rate swap, currency swap, repo, etc. And also very important, supply chain SME. So we also have sustainable trade finance available in addition to cash management. And last but not least, carbon trading. Carbon trading, we have seen a very strong uptick with even clients from China, Korea, Singapore, Hong Kong gone out to purchase carbon credits in the EU ETS market. Now, with that, let's dive deeper into the ESG bond and loan sessions, and I will pass back to Ariel. Thank you.
Sure, thanks, Tracy. So yeah, as Tracy mentioned, I will go a deep dive into more details about each of these types of bonds. So for the first type of bond, we shall consider a green, social, and sustainability together because there are many similarities between these instruments. So these are, as mentioned previously, these are use of proceeds instruments where the proceeds are allocated to finance or refinance green and or social projects. So for the green bond, this will be used to finance green only projects. For social bonds, it will be for social only projects. And for sustainability bonds, it will be a combination of green and social projects. So for ICMA and Loan Market Association, these have laid out 10 different categories of eligible criteria for eligible green projects that can be financed using green bonds or loans. So these include things like renewable energy efficiency, which is investments that would typically improve energy efficiency by a specified percentage, pollution prevention, which could be to do with waste management, waste treatment, and reducing air pollution, clean transportation, which includes public transportation, metro, light rail, or electric vehicles. So just highlighting some of the more commonly used categories. And finally, also green buildings, which are buildings that are meeting certain specified standards globally, be it LEED or BREEAM or IFC EDGE, etc. Next, for social bonds, the ICMA or Loan Market Association have given us 6 categories that we can focus on when we are looking at eligible social projects. Firstly, there is affordable basic infrastructure. So these are investments that seek to improve infrastructure or access to, for example, to rural areas, to electricity, to water, to sanitation. And typically we have to identify the population that is being served. So for example, when we look at telecommunication infrastructure, we wouldn't look at improving 5G within the city center because the people living there are already benefiting from pretty good telecommunications technology. We'll look more at looking at underserved or underserved populations in rural areas that do not have access to these technologies in the first place. Secondly, there's also access to essential services, which includes healthcare and education. So these are typically linked to public schools or public hospitals that would serve general population, including some of the socially disadvantaged populations. There's also affordable housing, which is to do with social housing or public or rental housing. Employment generation, which could include SME financing, because SMEs are a very important part of many economies, food security, and social economic advancement and empowerment. Yep. And for sustainability bonds, it would just be a combination of either green or social projects. There isn't a specific percentage mix that we are looking for, but we would try to strive for an even balance between the green and social projects. There's also one more type of bond that is known as SDG bond. This is more of a thematic label that some issuers, especially sovereigns, ascribe to their bonds, but essentially it is a sustainability bond because it is refinancing social and green projects. Okay, move to the next slide, please. So moving on to the next slide, we do have another kind of thematic bond, which is known as blue bond. So this is a kind of a more rare type of bond, and only specific issuers that we have seen include development banks and sovereigns that have issued this type of bonds. So blue bonds can be seen as a subset of green or sustainability bonds because it is serving maritime or ocean-based projects. So from that perspective, it could be a subset of a green bond because it's used to preserve and restore marine or coastal ecosystems, reduce marine pollution. All of these are kind of green activities. But at the same time, it can also be a subset of a sustainability bond because it could serve ocean related livelihoods of, for example, small fishermen, etc. So these would be actually a subset of green or sustainability bonds. Moving on to the next slide, please. So for sustainability-linked bonds and loans, as mentioned, that there are no specific use of proceeds to be financed under this under sustainability bonds, linked bonds or loans. The proceeds can actually be used for general corporate purposes. However, the issuer typically has to set an external target that they would achieve. So these would be aligned to, for example, their science-based greenhouse gas emissions reduction target, or some of the other green material, environmental, or social topics within their sectors. So for example, in the sustainability linked bond market, NL was the one who issued the first ever sustainability linked bond. This is a gas and electricity transmission and distribution company, and they have experimented and innovated with this format extensively. So their target is linked to reduction in scope 1 greenhouse gas emissions by a specific date, and they have issued a large number of sustainability linked bonds. A key feature of sustainability linked bonds is financial or structural characteristic change, which is tied to the achievement or non-achievement of the sustainability performance targets. So if the issuer does not achieve its targets, typically it would face a coupon step up or step down reduction. What we see so far is that typically in the bond market, following on to what Tracy mentioned earlier, for the bond market, the payoff has been asymmetric to the investor as compared to the issuer. So what it means that for the bond market, typically there is a step up penalty to the issuer that they have to pay if they do not meet the target. But if they do meet the target, there is no change in the bond characteristics whatsoever. But for the loans market, we understand that it could be a mirrored structure, or it could be a benefit only structure. Moving on to the next slide. Yes, so for transition bonds, as mentioned, these are for issuers from hard to abate sectors such as shipping, aviation, power generation, or steel production. So these are sectors that contribute a high percentage of greenhouse gas emissions globally, and also pretty hard to reduce the emissions. So what we need for this sector is to raise financing for specific transition projects that will help to reduce the greenhouse gas emissions significantly. So for example, in the steel sector, we can see this as a change in maybe steel production methods from using blast oxygen furnaces to using electric arc furnaces, which can run on natural gas and hydrogen. So these would reduce the emissions significantly in line with industry established science-based pathways. So for transition bonds, what we see is that use of proceeds are typically sector specific, and we typically will also look to some of the second party opinion, which we'll go into later, guidance on what are some of the eligible projects in each sector. Furthermore, in 2020, ICMA released the Climate Transition Finance Handbook, and this is providing guidance towards transition issuers of what kind of disclosures they need to share with the market when they're issuing transition bond. So they need to share with the market about their transition strategy and governance, which should be aligned with the goals of the Paris Agreement. They should also focus on areas that are material to their business and not small areas that aren't core to their overall operations. They should follow science-based targets and pathways and demonstrate how they are meeting these pathways, as well as a CapEx or implementation plan to show how they can achieve these overall reductions in their business. And moving to the next slide. Sure, so currently I'll also quickly go over the ESG bond and loan issuance process. So in general, as mentioned, there are two types of instruments. These are use of proceeds instruments, like the green, social, and sustainability, and the sustainability-linked instruments, which are sustainability-linked loans and bonds. So for each of these instruments, there are slightly different requirements to be met in the market. Specifically for bonds, they would typically require a framework when you are trying to issue either a green, social, or sustainability bond, and also a sustainability-linked bond. So we will go into more details of what the framework contains in the later slides. But the framework, basically, it would tell the issuer, for example, tell the investors what use of proceeds are being financed, what kind of targets they are using for the sustainability-linked bond, etc. And after we create this framework, we will go and get a second party opinion or verification on this framework to show that it is aligned with the principles from ICMA or Loan Market Association. As mentioned, for green social sustainability bond, it is tied to specific use of proceeds. But for sustainability linked bond, their proceeds can be used for general corporate purposes. So the situation is somewhat similar in the loan market, but also there are some differences. So for green loan, we see that a framework is actually optional. But one of the more recent trends we are seeing is that issuers who have the ability to access both bond and loan market, they typically make one framework that can apply to both bonds and loans, and they can easily use the same framework for the green loans. But in general, it is optional. And if no framework is utilized, there will be an external verification of the underlying assets. But if they do have a framework, they can use the same second party opinion as in the bond market, and is tied to specific use of proceeds. Secondly, for sustainability linked loan, typically because these are more bilateral agreements, there is not really a framework needed, but there is an annual external verification that needs to be sought because the loan or bond characteristics will be subject to change if the issuer does not meet the targets. If an ESG rating is used as the basis of the sustainability linked component, a license rating would have to be sought. And as mentioned, the proceeds will be used for general corporate purposes. Sure, so now I'll walk through the steps on how we can typically create a sustainable finance framework. So as we are approaching the sustainable finance market, typically the first starting point we will start from is what kind of framework are we trying to create? What kind of instrument is most suitable for the issuer at the moment? Is it a use of proceeds kind of framework, or is it a sustainability linked kind of framework? And subsequently, we will align with different principles. So for the use of proceeds kind of framework, which is green, social, sustainability, transition, bonds and loans, this would be aligned with ICMA's green bond principles, social bond principles, sustainability bond guidelines, and the corresponding principles for the loan market. And what these actually require us is four key pillars. The first one is use of proceeds. So the framework is essentially a 8 to 10 page document that lays out all the procedures related to the specifics of ESG bond. So first component that we would inform the investors of is the use of proceeds, meaning what kind of projects actually qualify under our framework. We should lay out clearly all the different criteria related to the specific projects. For example, for renewable energy, there may be some carbon emission threshold that we need to meet in order to be eligible. Secondly, there is the process for project evaluation and selection. So what this tells us is how is the issuer going to select these projects that they're going to use to the bond or loan to finance or refinance. So they should typically have an internal governance committee that will review all these lists of projects, and then they will assess whether they are eligible, and then they would put it into the bond or loan. The third step is to look at the management of proceeds. So after the proceeds of the bond or loan are being raised, how are they managed or being tracked? Typically, they can be put into the general funding accounts, but then separately, the issuer should have an internal process to track and allocate these bond proceeds into specific green or social projects. And finally, the issuer should commit to report on an annual basis how they have utilized these proceeds into which categories until the bond or loan has been fully allocated. Separately, for the sustainability-linked bond or loan, the framework actually ties into different pillars. So as you can see in blue on the right, firstly, the framework should highlight what KPIs they have chosen. So the KPI in this case is referring to which metric. So is it carbon emissions? Is it carbon emissions intensity? Is it water intensity? Why you have chosen this target and why it's important to your business. The second aspect is the calibration of the specific target. So why have you chosen a specific reduction by, for example, it could be 30% reduction by 2030, and then the issuer will have to explain why they have chosen these targets and how it's aligned with the science-based pathways. The third part is the bond characteristics or loan characteristics, which means what's going to happen when the target is not being met. Is there a step up or step down structure? The fourth part is on reporting, meaning that the issuer is committing to report annually on how they are performing against these targets so that the investors can adequately assess their performance. And finally, they are committing to get a verification on an annual basis on these targets as well. Sure. So in terms of annual reporting, it's just a repeat of also what I have mentioned just now. So for green, to recap, for green, social and sustainability bonds or loans, typically they would need to report on an annual basis on what is the allocation into different project categories and also the impact of these projects. But for the use of proceeds format, typically they only need to report until full allocation. So meaning that if they have already allocated fully within the first year, there is not much need to continue reporting after that, even though it would be seen as a best practice. However, for sustainability-linked bonds and loans, there will be annual reporting required on an annual basis until the target date to show the performance of the issuer against those targets. So finally, we can talk about the selection of the second party opinion provider. So after the issuer has drafted the framework that contains the components that I mentioned just now, they will typically need to seek an external review of this framework. This is to validate or demonstrate to investors that indeed this framework is aligned with the principles that are laid out by ICMA and Loan Market Association. So this SPO second party opinion is typically a one-time process prior to the issuance, where after the framework is completed, we will get a second party opinion report. And there are a number of key players in the market, such as Sustainalytics, DNV, ISS, Cicero, Moody's, which used to be known as Vigeo, IRIS, and S&P Global. Some of these providers are also eligible under the Hong Kong Monetary Authority's Green and Sustainable Finance Grant Scheme, which Tracy will be covering later on. So the SPO process is typically a 4 weeks process, which starts with the issuer sharing the draft of the framework with the SPO provider. There will be a few back and forth, maybe a few questionnaires that need to be filled in for the SPO provider to conduct the assessment. But essentially, it is a desktop level assessment where there's no like on-site checking or like on-site work, but it's mostly exchanges over email, where the SPO provider will assess whether this framework is aligned to the best practices in and also the guidelines laid out by ICMA or Loan Market Association. So just move over to a few quick case studies of the innovative transactions that we have seen in the bonds market. And after that, Tracy will cover on the loans market. So for the Republic of Ghana, Standard Chartered actually structured an innovative sustainability-linked bond framework for the sovereign. So to give a bit of background, why we think that this is innovative is because for a sustainability-linked bond, typically it is more utilized by corporates, because corporates is not as difficult as for sovereigns to set a corporate level strategy that's approved by the board and then the whole organization commits to it. But for sovereigns, it is relatively more complicated because the country is so much bigger. There are so many more considerations. And also with political changes, it may be hard to set a specific target to complete way into the future. However, because there was a will to do this from the issuer side, we have helped this issuer, the Republic of Ghana, to structure the first ever sustainability-linked finance framework for a sovereign. So while we have explored a range of KPIs, eventually we have identified 2 KPIs that is most important to this issuer, which includes related to education, firstly, and secondly, healthcare. So for education, the sovereign has a program called the Free Senior High School program, which is to encourage more students to be able to access senior high school at the tertiary level by providing it for free. So through this program, they've already seen some progress to increase the completion rate in the senior high schools, and they would like to increase it further by 2030 to reach 75% completion of senior high school. And furthermore, they do have some programs to increase the number of hospital beds. This is particularly in response to the COVID-19 pandemic. And they have set the target to increase the hospital beds per capita by 2030 as well. So for this first ever sustainability-linked bond framework for a sovereign, we sought the second party opinion of Sustainalytics, and they have provided a pretty robust assessment of the KPIs as being very, very strong to strong, and ambitiousness is ambitious, which is the highest level that they could give in the sovereign context. After this, we did see other sovereigns use this format, including Republic of Chile, where they have used an environmental KPI instead of the social like we used in this case. Moving on to the next slide, please. And I'll also wrap up with this Etihad transitions to Cook case study. So as mentioned, the transition bond is for issuers from hard to abate sectors. Aviation or airline travel is pretty fuel intensive and greenhouse gas emissions intensive. However, there is no immediate replacement of this form of transportation at the moment. So what we can do is best to improve the way that things are being run at the moment. And so for Etihad, this issuer has programmed to replace their fleet of aircraft to much more efficient aircraft, which can be 20 to 30% more efficient than the previous batch that they are replacing. So overall, this will also reduce the greenhouse gas emissions by a similar amount. They are also investing in sustainable aviation fuels. So by changing the fuel mix, we can also reduce the greenhouse gas emissions. So in terms of this, we have made quite an innovation because we have combined both the use of proceeds format and sustainability linked formats into one instrument. So as mentioned, the sustainability linked formats doesn't need to have a specific use of proceeds, but this issuer chose to use the proceeds for this replacement of the aircraft, which is the transition use of proceeds, and also tag on a sustainability linked angle at the same time. So if we could move to the next page. This highlights that the issuer has specific targets to reduce its carbon intensity, which is a CO2 per revenue ton kilometers being traveled over its passenger and freight businesses. And this, they have a target to reduce it to a specific level of about 18 to 20% by a specific date in 2024, 2025. And this is in line with some of the international pathways that have been laid out by the Transition Pathway Initiative. And finally, just to wrap up this case study, one of the other innovations that we have used for this transaction is that we have introduced a ratchet structure. So as you can see on the green table at the bottom left, this actually shows that if instead of having just one number that we can look at, which is the final target, if the issuer is performing slightly under it, there's a ratchet structure, meaning that they can have a different kind of penalty that's being paid based on what the final achievement of the target is like. And finally, also, instead of using a step-up structure in this transition and sustainability linked sukuk, which is the Islamic structure, we used a purchase of carbon offsets instead. So these carbon offsets, in fact, they are not eligible to be used under the issuer's existing commitments. So if the issuer faces this penalty, they will buy the carbon offset and immediately cancel it, meaning that they can't use it to their existing net zero commitments. But this is above and beyond what they will actually do on a normal basis. And we did get a positive second party opinion from Vigil Iris. Yeah, so I think this is all from my side.
Thank you, Ariel. Need to give her a break to take the breath. Thank you so much for sharing. So before I share the loan case studies, I want to encourage everyone to post your questions. I have seen a lot come through, and I have answered a few. And after these sessions, we will also pick up the Q&A. So I encourage you to post your questions. So here we have seen, learned a lot from the ESG bond market, label market. And now let's switch gear, looking at the sustainability linked loan case study. As I mentioned at one of my earlier slides, over the last 3 years, we have seen this market growing significantly. I think it's attributed to a few causes. One is, as Ariel mentions, instead of the use of proceed, sustainability linked products can allow you with the flexibility to address on working capital, because the target setting, the key performance indicators are set and linked to the company or the borrower sustainability target per se. So it widened up of in additional to the sustainable finance market on use of proceed base, and this can address on working capital also. Now, secondly is the pricing structure. So the incentive, the borrower incentivized if you over and above and achieving an ambition target for your sustainability commitment, you are entitled to incentive structure. And also on the other side, the use of I try to avoid saying the penalty words, but the mirror structure on the other side. If you not able to deliver, there is a step up coupon associated to it. So this structure is another, I think, is one of my favorite structure. I feel that is more transparent to really help to articulate the measurable and ambitious sustainability target. Now, in front of us, there are a few transactions on sustainability link that recently transacted. I want to share with you a couple from the semiconductor industry, both addressing on the KPI, including very typically, and like Ariel's earlier case study have shown, on GHG emissions. So during the borrowing, the financing, the borrower are committed to reduce their GHG emissions over time, and every year they have to send this data to the lender and say, and these data need to be externally verified and say that I have either hit the target or I missed the target, and the margins, so the interest or the margin is tied to the performance as such. Other indicator on these semiconductors transactions that we see in front of you, including air pollutants emissions, water quality, and also increase and the renewable energy. And on the other side, on the semiconductor, the ESG deal looking at also tied to the Dow Jones Sustainability Index as well. And another industry, on the gas industry, we have seen that pick up and using a sustainability link structure to articulate their GHG reductions over time, and also the social KPI was used. And another one on shipping industry, we have seen a quite significant pickup, and they will look to using the average efficiency ratios of per their vessels, and then the target will be setting on improving on even more than what the shipping industry association have set to the market. Let me see. So for the private equity deal that here, I have a separate slide to go through a little bit more detail. And lastly, to wrap up on the Ghana deal, this is a Sovereign Sustainability Link framework that was done for the Republic of Ghana, and then it tied to the KPI tied to the senior high school, and also the number of bed that was per capita. Now, let's take a deep dive into this private equity subscriptions fund that we have set the sustainability linked loan structure. So as Ariel mentions, SPO, second party opinions, widely adopted in the bond market, and we have increasingly seen more and more of syndication loan, or even sometimes bilateral loan, adopt the SPO opinion. Now, this is one good example. This is the second party opinions report for this particular private equity deal. And I'm very proud of this deal. On the right-hand side, we highlighted there are 4 KPI being set for these transactions. And the first one is addressing on the G, the governance. When this is looking at how to improve and enhance the ESG assessment during the due diligence process when the fund go in to look at the underlying portfolio company selection. So the G. So the ESG, the first KPI hit the G. Now the second KPI is looking at the GHG emissions reporting and improvement of the underlying portfolio company. So the G and the E. And now the third KPI, looking at the S, social, looking at gender diversity in the portfolio company, setting target on guiding and stretching the underlying company, the improvement in the gender diversity. Now the fourth KPI, so the first 3 KPI set at portfolio company level, and the fourth KPI set at the entire platform, the fund PPEA platform, on covering both its own operation and portfolio company, and going through the SBTI journey and targeting, looking at the E, the GHG emissions again. So this is a very holistic deal on addressing the whole E, S, and G at portfolio level and at the fund level. And in addition to that, we have also structured a carbon credit mechanism to this deal, like Ariel mentions on the earlier deal on the if we do not achieve this KPI, that's the step up coupon by purchasing carbon credit to the fund. So we believe this is a very innovative structure, and we have seen increasing interest on this in the market. Now, with that, let me also highlight, I think Ariel also mentions, so Hong Kong Monetary Authority have rolled out the Green and Sustainable Finance Grant Scheme. And this is a providing subsidy for first time bond issuer up to a cost of 2.5 million Hong Kong dollar subsidy, and also for covering cost of external reviewer on both loan and bonds up to 800K Hong Kong dollar subsidy for external reviewing. So for example, the SPO second party opinion clause, and also the subsequent reporting on the SL. So for the sustainability linked loan structure, we have the borrower required to submit external verified reporting. So this grant scheme also cover this external reporting costs as well. So it's been widely adopted and well popular in the market. And the recent update of this grant scheme has lowered the minimum size amount for the loan to only 100 million Hong Kong dollar. So this is very encouraged to see how the market has been adopting this grant scheme, and how our Hong Kong monetary authorities commit and promote the green and sustainable finance market. Now, with that, I will open up for Q&A, and I see a lot of questions came through. So let me take a look at a few and answer some. I see one on the bond area. I'm going to bring you back for these questions. So the questions is, what matrix do you use to structure ESG-labelled bonds? What data to use? How to obtain, to monitor and evaluate the ESG performance?
Sure, thanks, Tracy. Yes, so this ESG metrics that we are using, these actually is dependent on which kind of structure that we are going for. So typically we won't, for example, for the use of proceeds instruments like green, social, or sustainability bonds, we are not exactly looking at the issuer level performance, but we are looking at the specific assets or projects being financed with the overall view that, as the issuer is making more and more investments into this green and social investments, then their business is overall becoming more and more sustainable, and it gives the investors a direct exposure into these assets. So for the use of proceeds instruments, first and foremost, we will look at what kind of underlying projects does the issuer has. Are they investing more in renewable energy? Are they improving the efficiency of their manufacturing processes? And then we will look into these as the starting point for our use of proceeds instrument. So for some of the specific categories, there are some criteria or thresholds that need to be met. So for example, for hydropower assets, typically we will look to some specific threshold or carbon intensity threshold. So this is some of the metrics that we may need to evaluate whether the project can be considered green or not. Another example I have is, for example, clean transportation. So if the issuer is investing in a fleet of electric vehicles or hybrid cars, specifically, we will need to make sure that for electric vehicles, it's mostly zero direct emissions. But for hybrid cars, then typically there's still some level of emissions, grams of carbon dioxide per passenger kilometer. So we need to make sure these metrics, if we call it a metric, is aligned with what is being accepted in the market. So typically the issuer has to report on how they are. They firstly lay out the criteria in their framework, and then they have to make sure that they are aligned with their own framework and be able to report on that. And the second aspect of the question I would think is related to sustainability linked issuances. So typically here we are looking at some of the material topics for each sector. Definitely, most of the time, greenhouse gas emissions is going to come out as one of the more important ones, even though there might be other aspects like water or waste, or some of the social like gender diversity that may come up for other sectors as well. So previously, the market was pretty nascent, but as it has grown, we do see more and more examples that we can take reference to from a multitude of sectors of what is typically considered material, what kind of KPIs do investors look at for different sectors. Yeah, so I would say this is the starting point for both instruments.
Good. I just writing up on that. There's a questions on how long are the tenors of the bonds usually, and could they match the investment horizons of the underlying projects?
Sure. So for the use of proceeds instrument, while it is a good idea definitely to match the tenors, this is actually not required because for the use of proceeds instruments like green bond and social bonds, they recognize that the fungibility of funds, right? So and the exposure, the credit aspect of this instrument is linked to the issuer level credit worthiness rather than the credit worthiness of the specific project, like the solar project or the wind project, for example. Yeah, so there is a sort of a distinction that we can draw between these two aspects. And we do see that for green bonds, typically green bonds also use of proceeds instruments, issuers typically report or look at the instrument on a portfolio basis. So they don't have just one asset that they are trying to finance. They have a whole list of assets that they can be financing. And what they need to ensure is that the whole size of this portfolio is matching the size of the bond allocation throughout its life. So because of this flexibility, the bond instrument can actually be as long as you want. We have seen 25 years instruments price, 30 years instruments price. And this just ensures, makes sure that the means that the issuer has to do the continuing monitoring and ongoing reporting as long as the bond is still being active and the portfolio changes over time. For sustainability-linked bonds, it's a slightly different concept because the KPI is typically related to the bond tenor as well. The KPI testing date, maybe it can be halfway through the bond tenor, or it can be 90% through the bond tenor, with which we will have a kind of a back-ended kind of step-up structure. So for this, we tend not to see the KPIs going too long because it's quite difficult for companies to set a 20 years target and know that they're going to achieve it. The market was starting out with more shorter tenors, about 5 years tenor, and it has slowly broadened out to about 10 years tenor when the issuers are getting more confidence to set 2030 targets. The longest one I believe is probably around 20 years, but there's only one isolated example for the bond market.
Thank you, Ariel. So let me have a step on this one. So there's a question saying that if the borrower cannot fulfill the KPIs, what consequence will be brought to the borrower? Does the borrower need to repay the loan? So there are two types. So on sustainability-linked loan, as I mentioned, majority of the European market are both sided. So if you fail to fulfill the KPI, there will be a step up of coupon. So you have to pay the penalty. And also there is a disclassification clause as well that will be used if in the case of the structure doesn't met anymore. But it will not affect the credits of the loan. So basically your sustainability-linked loan and become a standard loan and not a linked structure and being declassified. Do you have anything to add on this? Is this one, Ariel? Okay. Right. Okay. And then I also see there's these questions on what extent will China succeed in its 30-60 goal, especially in financial industry. Okay, so with the China commitment of achieving the peak at 2030 and carbon neutrality by 2060, this is a massive leap forward for the whole global market to march closer to the Paris Agreement goal. Now, with that, the China Green Finance Committee has estimated that we will need 4 trillion RMB every year to invest into green and sustainable finance project to channel capital to address this enormous amount of funding gap into the market, which represent a huge opportunity. And with that, of course, private capital is essential and will play a major part, and financial institutions will play a major part. In addition to, of course, with the right policies and standard and regulations in the market to guiding it through as well, which China PBOC and CBRC it has been the first issuing to green bond catalog, and with the latest, the common ground taxonomy driven by the effort from June as well. on the harmonizations between the EU-China taxonomy as well to create a harmonized standard for the two markets. So a lot of development in this place, and from financial institutions have to play a big role in additional to policy and standard. I think Ariel's line has must have some problems and gone offline. I'm sure she will come back and join us shortly. Let me have a look at other questions here. I see that have we seen any initiative on working capital short-term financing side? So yes, so as I mentioned, the working capital can be now using sustainability linked structure to address, and short-term financings, one of the slides I showed earlier that have the wide scope of product available in the market, including sustainable trade. And within sustainable trade financing, there's a lot of short-term loan financing that facility. So following the same principle of either from use of proceeds based or sustainability linked loan. I think I heard some background noise. Okay, yes. So the answer is yes. And there is the short-term loan. We have seen it quite frequent from the sustainable trade product offering that we issue out. I see Ariel, you came back as well. That's great. So I think there is one on bond. Let me read out this one. Is it more usual for banks or other financial institutions to issue sustainability loans or bonds or sustainability linked loans or bonds? Is there any noticeable difference in coupon between these two types of instruments?
Sure, yeah. So for financial institutions specifically, a point that I should have mentioned as well. So for sustainability linked instruments, typically the main borrowers or issuers are the corporates. And also, as I mentioned, the sovereigns was a growing space. But the reason is because financial institutions, they have not really accessed this space. I think so far we've only seen 2 financial institutions issuing the sustainability linked format. The main reason is because their banks are subject to a lot more regulation, and when they're issuing certain kinds of regulatory debt, like regulatory capital structures under Basel III, like additional tier 1 or tier 2 instruments, these instruments cannot typically have additional step up, which is seen as an incentive to redeem. So for financial institutions or banks, primarily we have seen them issue in the use of proceeds format, which can be green, social, or sustainability, mainly in green and sustainability. And the question about whether there is a coupon or pricing differential between these two instruments, this is a fact that is often mentioned on in this market, but it's also rather hard to empirically prove unless that because there can be many factors that affect the bond price. So unless we issue the green instrument and sustainability linked instrument and conventional instrument in the same day, same market conditions, same tenor, it's very hard to empirically prove that there's a difference in such pricing. But we typically see that there is a certain increase in demand and investor diversification when we issue these kind of instruments. And between green and sustainability linked, typically this comparison is not made. It's often made with conventional debt, and we typically don't see these instruments as being a like-for-like comparison. But yet for the greenium overall, there is slight benefit in terms of comparing with the conventional debt.
Thanks, Ariel. I think we're running out of time for the session. So thank you so much for joining us. And this event is recorded, and the material and the recording will be posted on the Alliance website. And more trainings will be rolling out from the Alliance. So please stay tuned. Once again, Standard Chartered is delighted to be the cornerstone member of the Alliance, and thank you for HKMA and IFC for launching this Alliance of the Green Commercial Bank platform. And we look forward to working with you all to drive a more sustainable finance future. Thank you so much for having us, and thank you for your time.